Let's say I have current assets of 100 million and current liabilities of 75 million. And with this information, if I calculate the current ratio, it will be current assets by current liability, and it is 100 by 75. So it is 1.33. So what I can infer is, when my current ratio is 1.33, it means 75% of the current assets are funded by current liabilities. And what is even more important is the remaining 25% of the current assets, that is current asset minus current liability, the remaining 25% of the current assets are funded by long-term funds. Funded by long-term funds, we technically call them as net working capital. So when the current ratio is 1.33, we can safely conclude that 25% of the current assets are funded by long-term funds. It means there is a 25% long-term fund contribution for creating current assets, and that's what most of the banks stipulate as margin for working capital. If current ratio is 1.33, then there is 25% contribution. And that's the reason most of the banks insist on current ratio of 1.33.